Let's jump right into a fascinating transformation story today. We're talking about Broadcom. Look, if you're still thinking of them as just the folks who made the chip in your old Wi-Fi router, we really need to update that view. They've quietly and, honestly, ruthlessly transformed into a massive dual threat in the modern tech ecosystem. They are now an absolute powerhouse of both custom artificial intelligence silicon and critical infrastructure software. So let's dive into this and see exactly how they built this engine.
Which brings us to the billion-dollar question. Broadcom is undeniably one of the absolute biggest winners of this massive AI infrastructure boom we're living through right now. The broader market knows it, and the valuation has absolutely skyrocketed to reflect that dominance. The stock is sitting right around $419 a share as of June 2026. So for the focused investor trying to allocate capital, the crucial point is this. Is this opportunity still attractive today, or has the easy money already been made?
To figure that out, we're going to break down exactly why investors care so much right now, look under the hood at their financial strength, objectively stress test what could go wrong, tackle the valuation debate, and then land on a final verdict. Let's get right into it.
Starting with Section 1, why investors actually care, and this incredibly unique AI and software moat Broadcom has constructed.
So their business model is brilliantly split into two distinct but highly complementary engines. On one side, you have the high-octane growth engine, the semiconductor solutions. We're talking custom AI accelerators and the high-speed Ethernet networking silicon that literally acts as the nervous system connecting massive AI server clusters together. On the other side, you have the infrastructure software, which got completely supercharged by their massive VMware acquisition. Think of this as the cash flow stabilizer. You're getting the explosive upside of the AI hardware boom paired directly with the sticky, recurring revenue of private cloud software subscriptions. It's a rare and incredibly potent combo in today's market.
Now, when we talk about that hardware engine, this 143% figure is just wow. But let's look beyond the percentage. What that actually represents is Broadcom's year-over-year AI semiconductor revenue growth for the second quarter of fiscal 2026, hitting an astonishing $10.8 billion. They are quite literally the premier arms dealer in the hyperscaler arms race right now. As cloud giants build these mega AI data centers, they desperately need Broadcom's custom silicon to maximize power efficiency, and they need their networking gear to make millions of computations actually talk to each other seamlessly. That 143% is the literal sound of infrastructure being built at breathtaking speed.
All right, moving on to Section 2. Let's see how this top-line explosion translates into actual business health and profitability. Top-line revenue growth is great for headlines, but bottom-line reality is what actually pays us as investors. 69%. That is their adjusted EBITDA margin for Q2. For those newer to the term, EBITDA is essentially a measure of core operating profitability. 69% equates to over $15.2 billion in a single quarter. You know how rare it is to find a company scaling its top-line revenue at nearly 50% year-over-year while maintaining a 69% margin? It's basically unheard of. It proves they aren't just buying growth at all costs, they're executing with an elite level of efficiency.
And that brings us to what I'd argue is the absolute core identity of Broadcom: elite cash conversion. Looking at revenue against free cash flow reveals a staggering reality. In Q2 alone, they generated $10.2 billion in free cash flow, which is a 46% margin. Why should you care about this for your investment thesis? Well, Broadcom carries about $45 billion in net debt from their massive acquisitions. But with this kind of cash hose, they can easily service that debt, pay a highly meaningful dividend, buy back their own stock, and still aggressively fund the massive R&D needed to stay ahead in the AI race. Cash is oxygen, and man, Broadcom is breathing easy.
Okay. Time for a reality check. Section 3, what could go wrong? The classic yes, but scenario, where we stress test the seemingly perfect execution.
Every great investment carries risk, and Broadcom has 5 major headwinds you absolutely need to watch. First, valuation risk. When expectations are priced this high, any tiny miss in future guidance can trigger a violent sell-off. Second, and this is massive, customer concentration. Their top 5 customers make up about 40% of total revenue. Even more sobering, a single, unnamed tech titan accounts for 32% of their revenue alone. If that one major customer pivots their chip architecture or delays orders, that's a sudden, massive hole to fill. Third, they're highly dependent on hyperscaler capital expenditures. Fourth, geopolitics and supply chain hurdles. And fifth, VMware execution risks. Pushing inherited customers onto subscriptions usually means price hikes, and aggressive pricing changes could easily lead to major customer backlash.
Zooming out to the macro level, the environment is definitely a double-edged sword for them. Take interest rates, for example. Broadcom is a long-duration growth asset that utilizes corporate debt, so stable rates are great, but higher for longer rates actively pressure their valuation multiples and make refinancing that acquisition debt way more expensive. Or look at geopolitics. They rely heavily on overseas foundries, and roughly 17% of their expected fiscal 2025 shipments are tied directly to demand from China and Hong Kong. Export controls, tariffs, trade restrictions, these aren't just news noise. They directly and immediately impact revenue and profit margins.
Keeping those specific risks firmly in mind, let's jump into Section 4, the valuation debate. It is time to ground the hype and look at the math.
This is where the rubber meets the road. If we run a custom discounted cash flow valuation model against the current $419 share price, the base case intrinsic value comes out to roughly $543. That implies nearly 30% upside if Broadcom keeps crushing its AI revenue ramp and maintains those elite free cash flow margins. The aggressive bull case is way up at $859. But look closely at the bear case. If overall AI growth slows down, margins normalize, and the market compresses their multiple, this stock could realistically drop to $312. That is a 25% haircut from current levels. The primary takeaway here, Broadcom is a wonderful, dominant business, but it's absolutely not a low-risk, deep-value stock.
And that creates a pretty fascinating conflict in the models that we have to address. On one hand, the cash-based DCF model absolutely loves Broadcom. It rightfully credits the company for its durable, multi-year runway of tangible cash flow. But on the other hand, relative valuation metrics are flashing severe warning signs. The headline price-to-earnings ratio is sitting above 100x right now. Even when factoring in accounting distortions from VMware, relative valuation models point to values much lower than the current market price. When valuation models conflict this sharply, it means the investment case is highly sensitive. It means Broadcom basically has to deliver absolutely flawless execution to justify the premium price tag.
Which brings us to our fifth and final section, the final verdict. After analyzing the twin growth engines, the cash flows, the sobering risks, and the highly conflicted valuation, to buy or not to buy.
Here is the objective breakdown laid out clearly. Broadcom is a selective buy. It is definitely not an automatic blind buy at any price. On the buy side, that nearly 30% upside to the $543 base case is super compelling, driven by world-class free cash flow and structural unavoidable exposure to the AI rollout. On the wait side, you have sharply conflicting valuation models, the unrelenting demand for flawless execution, and that massive 32% single customer concentration. So, discipline is everything. Around the current $419 level, it's an acceptable starter position if you have a long-time horizon and can stomach the volatility. But the real mathematical margin of safety kicks in closer to the $360 to $380 range should the broader market sell off.
So the crucial takeaway I want you to remember from this explainer is this. Broadcom is a potential long-term compounder, not a risk-free investment. The underlying business is exceptionally high quality. They've aggressively constructed an absolute fortress of an AI infrastructure runway alongside incredibly sticky enterprise software. But the sky-high expectations baked into the current valuation demand deep respect and very strict portfolio position sizing.
I'll leave you with this question to ponder. We've seen the elite cash generation. We know the massive, undeniable AI tailwinds, but we also know the high expectation valuation and major customer concentration. Looking at your own investment strategy and goals, does your portfolio have room for this very specific, high-quality but high-expectation risk-reward profile? Think about it. Thanks for joining me on this deep dive into Broadcom. Keep learning, stay disciplined, and I'll see you next time.